All right, stock started the month of November with quite the move today, specifically in small caps. So we're going to break down that small cap breakout from a technical perspective on the index itself, and then what actually fueled the breakout, what actually is driving behind it, to see whether or not that it has the staying power and the ability to really trend from here after not trending for so long, or is it have the makings of a fake out, where it looks like we're going to break out, but then we don't have the juice to keep it going, the escape velocity to keep it going, the atmosphere just drags it back down. Gravity, drags it back down. So we'll take a look at that, at those elements of what's driving today. We'll also take a look at a stock that's kind of associated with the reopening trade and a lot of what drives small cap relative strength. And we'll talk about how to trade that kind of, with this idea again of what's fueling the breakout. And so let's go ahead and get started. Today is Monday, November the 1st, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's take a look at the S&P 500 and see how things finished today. As you can see, we had a yearly high on the S&P. You got the nice green tag here on the chart. So a new all-time high, new intraday high for the S&P 500. You can see we're still gradually moving higher. Still up almost 4% up above the 30-day moving average there. So very strong move. The near-term line still above the 90th percentile. Very strong to get up above the 90. Solidifies the intermediate line in the upper reversal zone. And if at least for the time being, it's halted the market sentiment line's descent out of the upper reversal zone. So it's kept it in there. Came very close to a cluster yesterday, on Friday, or last week on the previous session on Friday. We actually did get an overbought cluster on the NASDAQ 100, just barely finished at 80.36. We are 5% up above the 30-day moving average. You can see that appears to be right around the limit on the normal move higher, and we did get a little bit higher over here, but we never did get a cluster over here on this run. Typically, intermediate overbought clusters like this are really bullish when you're just starting an intermediate rally. So it's a relatively good sign that we can be bullish here for a while on the S&P 500. You do kind of have to be aware of the potential that it can reverse, right? Like typically, if you've been on an intermediate run for a month or two, up to 3, then they can be kind of signals that we're peaking. So just kind of keep an eye on this one, because I'm a little wary about this intermediate rally that we're starting. I have a sense that it might be more of an erratic instead of a nice prolonged grinding intermediate rally. They'll be more erratic for the reasons we talked about in last week's market outlook videos. So to kind of keep an eye on this one as to whether or not this will be one of those peaks is, again, see what happens here in the very near future, like tomorrow, Wednesday, as we get through FOMC and all of that, to see whether or not what does the momentum line do when it gets back down here. Obviously, any drop below the 5th percentile would be a big red flag. Any drop for the near-term line well into the reversal zone would also be a red flag that we might be coming. That might not be. That might be a bearish cluster, not just an overbought cluster, but a bearish cluster. But as of right now, considering that we just started this intermediate run, we'd look at that as a very strong signal. Of course, the bigger mover today was the Russell 2000. Came very close to a new all-time closing high. We got 2360 was our close back there on March 15th. We're at 2358 today, and obviously the high of the day was 2360. We closed right at the high of the day that particular day, and today we also closed pretty much right at the high of the day, only about 50 cents off there on a day where the range was 60 points. So very strong move, and obviously your near-term line on the initial thrust higher on the market sentiment or the intermediate posture didn't get above 90 there, but it did get above 90 this go around. So good sign. You can see too that we are about 4% up above, which previously had been a peak. That's higher than any of these other bullish moves since we peaked there in March. So we might be getting a little bit of a breakout pattern going on right now on the Russell 2000. Of course, your Dow Jones looks very similar to the S&P 500. Good bullish short-term sentiment continuing. We didn't get a cluster here, but good bullish trends going forward right now for all of these major indexes. And for that matter, good mature near-term rallies. You can see this near-term rally, we did dip below 50, but you got to dip in the bearish to end it, especially when you pop right back above 50 the next day. So really, we're looking at, a 1, 2, 3, we really jump back up above 50 over here. So really 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days on this current near-term rally, and the typical time frame is about 7 to 12 days. So keep that in mind, that we are in a mature near-term rally right now. And as you do pull back on any period that the blue line drops, because you can see the blue line drops frequently. That's not like we're calling for a bear market here. So when the blue line drops next and drops into the pink level, how far it drops it will be a consideration, and then where do we drop relative to this 43.40 area. As long as we stay there and we don't drop significantly below 20, then that's a dip you'll just buy, just like every other dip near-term dip that we get when we're on a dark green shading and a green line. So let's take a look at some of these other charts that we have. Let's take a look at the long-term chart. The Hakinyashi candles, you can see you got some good strong bullish candles here. Last week we closed above the prior week's high point. This week we already started off with a good strong bullish candle. Of course, the more higher we go, the more likely we are to close above the high again. So we'll just kind of keep our eyes on that. The Russell 2000 is the big breakout. So it's this is the first really strong bullish candle that we've had in a while. You can see the strong rally today so far has the close up above. See, we hadn't been above the prior high, and so we've been relatively neutral in all of these as well. One breakout right there, but this would be a pretty significant breakout. If we stay up in this area, because we'd break out above. We'd be breaking above the prior week's high point, closing above the prior week's high, but closing above all these other highs too. So it'd be very, very significant breakout for the Russell if we hold the week. It's only one day. So if we don't hold the week and we end up down at the lows of the week by the end of the week, then it's going to be very bearish. It would be a very long upper shadow. So very important that we hold this breakout. It would have been better had we got this move Friday, right? Because then that's how bullish you are to go in the end of a week. But we weren't bullish on Friday. We were bullish on Monday. So it's a little different to get a strong bullish pattern going into a period where you have. We were going into the weekend with about as neutral as it can. The bulls weren't very convinced. The bears weren't very convinced. So basically, that was about as neutral as the candle as you can go into a 2-day period where the market's closed, where anything can happen. So it would have been better had we had that yesterday or Friday, but we had it on Monday. So it's important because on Friday, then we can't lose it on the weekly candle, right? If you look at the weekly candle here, see that can turn into a long upper shadow by the end of the week. Whereas had we closed there, then we would have been up here. On Friday, if it had closed here on Friday, we would have finished with a very strong weekly candle. It'd been very bullish. So it's needless to say, it's very, very important that we hold this. If we end up with a long upper shadow up here by the end of the week, that's going to be, and you see we haven't had one. That's going to be very bearish by Friday. So very important to see kind of how these next 2 days, especially going through the FOMC meeting, and how that all plays out. You have a bullish pattern on SPY on the DMI. Now we have a bullish pattern on the IWM. So we have bullish breakout patterns on that. So very good sign from that perspective. Bullish chart on the RSI and the CCI. Bullish chart on the RSI and the CCI on the small cap index too. So breaking above 60. This is the highest RCI that we've had. Over here we got up to 64. Over here we got up to 60. 2 essentially, and just a little bit ago we got up to 63. So and over on this last peak we got up to 64.7. So being above 65 is the highest RSI peak that we've had. So again, kind of a good sign, and get it closing above 200 at the same time. Very good breakout potential on these oscillating charts. Let's take a look at the Ichimoku cloud for SPY. Obviously well above, and we have an intermediate trend started. We're above 65. We're above 2.5. We're not quite, to where we're above 5 and 80 yet, but we're certainly working our way in that direction. IWM, this is the first day that it has closed above 2.5, and above 65. See, we haven't done that previously. We came very, very close. Above 2 and above 65. We came very, very close over here. We are at 1.8, 1.9, 1.87, 1.75. We actually did get a smidgen above 65 right there, but this is the first kind of bullish breakout. So another breakout sign for the small cap index. When you look at SPY on the Bollinger Bands, of course, we are in the upper quartile. And here's the other issue about the potential for this intermediate run to be more erratic, to not be so conventional, is that we didn't start this with a breakout above the Bollinger Bands. Usually you start these intermediate runs with a breakout above these bands, and we didn't this go around. We are in the upper quartile, but on the other hand, IWM did break out above. So we broke up above the upper band, and if you take a look at the Keltner channel as well, so let me zoom in on that, you can see we broke above the upper band and the Keltner channel. And now the bands are breaking outside of the Keltner channels for the first time in a while. So again, another breakout pattern right there for small cap index. Very, very good sign for small caps in this particular chart. All right, and then let's see. So we looked at the Bollinger. Let's go back to the Bollinger. The 3 lines. This is the other chart I wanted to take a look at. So SPY, you can see the 30-day, we are easily above the 8 and the 17, well above the 30. But again, what matters right now is the 30 getting back above the 50, because it had dropped, not by much, but it had dropped a little bit there. So a little bit of a kind of semi-death cross with those 2 lines. But it looks like we're still above the 200, of course. IWM, we had also been above the 8 and the 17-day, but you can see now these 3 lines have converged. The 30, the 50, and the 200 have pretty much converged all on top of each other. Now they're starting to diverge a little bit. So that would be a good sign for the 30-day to start to pull away a little bit from the 200-day moving average. If I were to pull up, for example, the PPO, which is very similar to the MACD, but take a look at the 30-day and the 200-day simple moving average MACD. You can see, if I zoom down here, let me go to a 5-year chart. Here, let me get rid of this volume profile. So you can see how we had really converged. Like the 30-day had come down to the 200-day. And sometimes, here, let's just get rid of these other 2 really quick to make that chart a little easier to see. There we go. You can see sometimes you diverge, right? The 30-day crosses below. Sometimes the 30-day kind of comes to the 200 and bounces off of it, like we saw right there. So you get a little break below the 200, just like we did here, but we don't break through it, and we stay down long enough for the 30-day to catch off and then bounce up off of that. That appears to be what's happening as of right now here, that we've been sideways long enough. I mean, this is why we were sideways for so long, because it took that long for the 30-day to come down towards the 200, and now we might be diverging back away with all these breakout patterns that are going on. Let's take a look at the intraday chart for SPY. As you can see, we gapped up today, filled in that gap to the downside. Remember, that's still yesterday's low point. Still very still a gap down there that we want to keep our eyes on. And remember too that we don't have very much volume down here, so we moved up a lot. We've been sideways. But now let's take a look at IWM. IWM gapped up today. Again, some potential there for a runaway type gap that we haven't had for a while. If I were to go back out to, this chart right here. You can see IWM, the gap today wasn't too significant, even though we closed high. That it wasn't a strong, and you notice it wasn't the first time we've closed above 2%. Like we closed above 2% over there on the 27th. We closed above 3% on June. And these were coming off of some relative lows, and we did have a pretty strong down move last Wednesday. So, but these weren't followed up with trends to the upside, and this is a little. We'll see if that plays out here as to whether or not we're able to follow up on this 2% plus move that didn't really have a strong gap. So not the little bit of some potential for a runaway gap, and again, like this, right? That would be a runaway gap from back on the 14th. If you look at IWM, we had already started to fill in some of that gap, like on the 27th, you notice. So it kind of nullified the runaway gap potential there, and this doesn't have the makings of that. So again, you move up a lot on very light volume. If we fill that back in tomorrow, because there's not very much support below us because we moved up so far without a lot of volume. If we don't follow through with this breakout, if it's a fake out, then that's really, that would be not so bullish, right? So we really don't be surprised if we don't pull back towards last week's high point, that where we broke out above. But as long as we hold that and we bounce up to higher highs and we hold this breakout, then very, very good signs with all these breakout patterns all across the board on the Russell 2000. And with all these patterns, if it is a fake out, then that would be about as bearish as you could possibly be for a fake out. But it looks like it's leaning towards, and again, we would know if we fill in that gap, then obviously it would be a fake out because we don't want to get that low. Even if we were to hold the point of control, like you get back below that high point that you broke out up above, and that's not a good sign in this regard. So right now I probably would lean more towards this breakout holding because of all those indicators that are putting out there. Very good move, as you'll see later in the video today, on the energy that's fueling this. So it's not really a broad breakout, like we're not seeing like XLK breaking out and really moving to the upside. So we want to kind of see how we follow through and make sure that this is indeed, a trending move, the beginning of a trending move, and not just a fake out pattern because we had a good day in energy stocks today. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that would suggest why you're either a lot more bullish than I am, or whether you're a lot more bearish than I am. Share with us what you're seeing down in the comment section below. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you before our videos when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch them if you don't like them. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments do you have on anything I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, come over here, click on some of these things over here on the right, including our Market Outlook Live. If you click on this image, or you can come up here and click on Market Outlook Live Trade Review, it takes you to this page. This is where we review all the old Market Outlook trades. I actually closed out a couple today. We talked about why from previous videos. We already put on today's trade idea that you'll hear later in the video. We already put that on today before the market closed. We did it in this video again. So when you come to this page, 3:30 Eastern Time, Monday, Wednesdays, and Fridays, before my market outlooks, then you can be able to get that trade review there. Also, you can see our upcoming classes. If you click on View More right there, or come up and click on Trading Rooms, you can see our upcoming calendar, as well as our 3 years worth of archives that are on this calendar too. So check that out. Also, come over here, click on that heart. It opens up a new tab. Hit that like button. Also click on this thumbs up icon. Opens up another new tab. Hit that like button. Again, the more you do that, it helps our content get out to more of our followers. And this page has over 1,000, more than 1,000 followers, but only 82 people see it. Again, the more people that see it and like it, the more the algorithms put our content out to all of our followers. It also benefits you because the more you engage with us, the more Twitter and Facebook will make sure you see all of our content. So we always really appreciate those who do click on those like buttons for us. All right, let's take a look at how things performed here, and you can see the nice upward trajectory here lately, especially in the last few weeks, in all equity asset classes, with a big jump in small caps, of course, today. Commodity prices appear to have peaked about the time that the stocks really took off. It's about when they peaked and have pretty much gone flat. And you can see bonds have also, and gold has also gone flat, and the dollar has kind of stopped its ascent too. In fact, if you were to just to zoom in just on today alone, let's go out to November the 1st and just look at today. So new month, right? And you can see, I mean, it was pretty much small cap stocks by themselves. International stocks actually outperformed large cap U.S. equities. And then you can see commodities did well along with gold, with the weakness in the dollar bouncing back down, but and big jump higher in yields. I think that was our main driver of price action here today. Yields had been dropping back, which has been fueling a lot of the gains in the Qs lately. But you notice a 10-year yield bouncing back up today. Not the strongest rally, but at least it appears with this a couple haramis in a row that we may be slowing the descent. This pullback, that we might be bouncing back up and working towards a new rally to the upside. Again, you can see yields really started to take off right about, pretty much post September expiration is when they really took off to the upside. Let's go back over here to the asset class comparison chart and just take a look at since 9/20, September 20 there, since that post September expiration, you can see that bond yields have been rising, commodity prices have been rising, U.S. stocks have been rising, but not international equities, and the dollar's been up too. I mean, it's been a very inflationary trade. Gold's up with the dollar, but it was led higher mostly by commodities, and to some extent until today, large cap stocks and small cap stocks really kind of took the lead from there. So very interesting pattern, again, post September expiration, where yields really started to take off. And like I said, it appears that yields have been pulling back, a little bit of a near-term pullback. The MACD has dropped down towards zero, but not through it. The histogram has turned back up now, so that descent is slowing. Stochastics looks like its descent is slowing down with a little dip in the bearish territory, with the possibility that we can bounce off this 30-day moving average and roll up higher. And again, we've seen what that's done, right? That is a reflection of higher inflationary expectations. So we'll see how that benefits whether that's enough fuel to continue to push small cap stocks up higher into the future. Here is remember that's a 10-year yield. So TLT is the long term, is a 20-30 year bonds, and you can see they've been trying to bounce up. We've been in this golden cross environment, this kind of really nascent golden cross environment. We had jumped back above the 30-day moving average and the 8-day. Today's little drop that we had still kept us above the 8-day moving average. We're back below the 50 with the drop, but we still stayed above the 8 days. So very important to kind of watch to see. For us to be bullish going forward, yields rise, right, and bonds roll back down below the 200-day moving average, and we're back into a death cross environment, which would be bullish for risk appetite, right? It's not bullish for risk appetite for bonds to be in a golden cross environment, which they appear to be kind of starting one right now, and the question will be whether you can get through that point of control and rally to the upside or not. Here's the dollar. Let's take a look at the dollar relative to the euro. And you can see the big rise the dollar had on Friday that we talked about there, but then the bounce back today. And again, the bounce back today still didn't get you back above the 8-day. We held that 50-day moving average. We are in a death cross environment right now for the euro, so a golden cross environment for the dollar. If you take a look at the dollar index, which is mostly the euro, but it includes some of the other oscillators too. There's your golden cross environment. We are the 50s above the 200. We are above the point of control. We are above the value area of last year, and it appears that we were going to bounce above the 50-day moving average, but didn't quite hold that bounce. So again, for risk appetite's sake, you want the dollar to come back down and get back below the 50 and fill in this gap. By then, probably your 200-day will be close to where that point of control is. If bonds continue to move up and the dollar continues to stay in this golden cross above the 50-day and back above the 30, then again, that's not the most risk on either. Again, the dollar bottomed out here on September the 2nd, so it started to move higher on the 3rd all the way up to October the 12th. So from September 3rd to October the 12th, let's go back over here. Let's see, September the 3rd, after bottoming out on the 2nd and then going through October the 12th, you can see that was the strength in the dollar, the biggest move higher in the dollar, and look at what that did to equities. So we don't, if you're bullish on risk appetite, we don't want the dollar to continue to push higher. You want it to break that 50 and fill in the gap, at the very least, fill in the gap towards the 200 and start to converge, right? And then that will lead to a bearish divergence, and a death cross. But as of right now, it appears that we might be trying to bounce off that 50 and get back above the 8-day. And so really important to watch the dollar again throughout this FOMC meeting, because they're going to have a very big influence on with the dollar. If there's any kind of speeding up of the expectations of tapering and/or rate hikes, we've been talking about this a lot in our trading rooms last week. Going into today, as of Friday, the Fed Fund futures market had a 50-50 shot for 3 rate hikes. There was an 80% chance for 2 and 50% chance for 3 rate hikes by the end of next year. Well, 7 of the 11 FOMC participants currently don't see any rate hikes for next year. So the majority are not being transparent with what they're expecting. At least their transparency is suggesting no rate hikes. So the market appears to be dragging the Fed. So if that starts to change, if the Fed starts to get more hawkish, then could that create some bullishness for the dollar and some volatility again for equities as the dollar bounces off a new low and continues to trend higher. So very important to watch going in. I wouldn't be surprised if tomorrow we got a very flat day, and then on Wednesday post FOMC we started to get some kind of breakout move. So really important again within the next 2 days that breakout on IWM holds. If it can't hold, especially tomorrow when there's really nothing going on, but if it can't hold through that meeting by Wednesday's close, then we kind of know what we got going on then. Let's take a look at the sector performance. And you can see obviously the biggest sector mover here today was the energy stocks right over here. Here, let me go to the comparison chart here. And then pull up just today alone. So we'll go out to November the 1st, and zoom in a little bit on the chart. Energy was your biggest performer. Discretionary was the next biggest performer. Actually, it ended up being the biggest by the end of the day. Discretionary is your big winner, and that was not Amazon. That was pretty much Tesla. That was such a big winner for, let's go to by industry. Let's go to discretionary. So here's your discretionary stocks, and we'll take a look at your biggest market caps, which are here. There's Alibaba and Toyota and Amazon and Tesla, right? Those are your 2 biggest, and you can see Tesla having a big influence. And there's some of these Chinese stocks doing really well too. Alibaba doing really well, PDD doing really well. But your U.S. equities, Amazon and Home Depot, Nike, not doing nearly as well. Lowe's, you can see, Target, you have Starbucks and McDonald's having positive gains, but it was mostly Tesla that really drove a lot of that action. So you've got, your big winners today were Tesla and the energy sector, and really not much of anything else. So again, if that's what fuels a breakout in IWM, that doesn't sound very promising in terms of longevity. So we'd like to see, if I was going to be really bullish on equity, on small cap equities going forward, then we would want to see materials and energy and industrials and financials all up here, because that's been the MO previously for strength in small caps. It's been those sectors fueling the strength in small caps. When it's just energy and everything else is lagging or flat at best, then you don't feel so good, especially when utilities is your third best gainer, and that's not necessarily the most risk-on asset or sector that you would expect to gain. And again, going back to that 12 grid for all the sectors, there's that gain in energy. So, it puts the gains in energy in the context. I mean, it's a high number already at 19%, but it's been such a big mover, and even today's gain didn't really break you out of a range that energy has been in. So again, it also puts into a little bit of a concern about how much staying power that breakout would have if that's what's fueling it, and if Tesla's what's fueling the move in discretionary, and discretionary has gone parabolic and now has got an overbought cluster on that parabolic move along with XLK, then you don't really feel too confident about the staying power of that either. So again, that's your two biggest drivers today: is this kind of up day within a range in energy and a parabolic move in Tesla that's resulting in the sector getting an overbought cluster. So again, can that continue to push IWM out of its breakout mode? I'm a little wary about that and would lean more towards, depending upon how the FOMC reaction is, more towards it being a fake out than a breakout. All right, our trade idea of the day is a stock that's been associated with these sectors that are correlated to small caps, this kind of reopening trade, and that's Wynn Resorts. And you can see Wynn Resorts has been on this bearish market sentiment decline. The orange line's got, in fact, not only did it get into the bearish territory, it got into the lower reversal zone. You got a bullish cluster over here with all four lines on Wynn. So then you actually end up with a lower low point, kind of a divergent low point from there. And now it appears we're starting a new intermediate trend to the upside with some resistance, some very strong support below where we're at here, and some resistance up above. And the near-term line's not really breaking out here yet. It's a strong momentum line, but not really a strong breakout yet on the momentum line. You can see we tried over here and didn't quite get the follow-through on the near-term line. So that's the concern here, that you can kind of get that same kind of a pattern. If you take a look at the long-term chart for Wynn Resorts, we are in a death cross environment, but we are at least are coming up off of a low point right now on that. So that's a positive. You can see we are in death cross environment here as well. But that's a good solid break above the 50. So it's not necessarily a trending move, because you got to get above the 200 before you can really take off to the upside. But we can fill in that gap as those two lines converge, as the 250-day moving averages converge, kind of stay. And you've got some solid support. Obviously, they're 200, and all this volume up above, right around 100, would be a good resistance for the stock, as well as that old high point right above 200, about 107.5 or so. If you take a look at the some of these other oscillators for Wynn, you can see it's not quite a breakout. I mean, it's a great bullish day, but not quite the breakout pattern there that would suggest strong bullishness. If you look at the RSI and the CCI, you kind of see something similar there too. We're not in bearish territory. We're in neutral territory, but at least we're at the upper end of neutral on those. The Ichimoku trend cloud. If you look at, we are in the cloud. We're not below it anymore. We're not above the cloud either, and we don't have any kind of trending move going down below. So it's a sideways pattern. We're not. It's not quite a breakout pattern, and we're not breaking up above the Bollinger Bands or above the Keltner channels. But we at least are definitely not bearish anymore either. And if we are, there's a very strong support down here. So that leads us to the opportunity for a iron condor spread to be sideways here. So if we come over, you can see what I've done is I've sold the 85 put for December, and I sold remember we do have earnings coming up, so keep that in mind, but there's not a big jump in volatility here, so the market's not expecting anything crazy from earnings. Selling the 85, selling the 105, right around those low 20 deltas, so buying a strike out $5 wide for protection on that. So that's the setup. Again, position sizing for a normal normal position size, and getting a pretty decent return out of that. And those break-even levels you can see on the chart are pretty much at that high point for resistance and at the very strong support. So it gives me some room to go up without necessarily breaking out. And like I said, there's a lot of volume even above that where that line is. So if you were to get above there, it'd be kind of hard to really kind of break out there. So an opportunity that we can kind of stay between these volume nodes and trade right around this area and kind of flesh that out. I can definitely see like this becoming the point of control, this big strong volume node as you trade between 90 and 100 potentially over the next so many weeks, and we'll profit from that and take advantage of it. All right, well, that wraps this up for today. You've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Have a great rest of your Monday night, everybody, and we'll see you all next time.